All right. Well, thanks for joining us for Real Estate Roundtable. This
Happy
is
to be
my
here.
good friend DJ Gardner from Security National Mortgage, and he's going to talk a little bit about um, the mortgage situation in 2026 and what we can do about it. But do you mind if I share a little bit of my story
Yeah, go for
to
it. Love
start
it.
off?
Love it.
So, and you're familiar with it, but the viewers aren't. We found ourselves in kind of a unique situation. We sold off our business, and we had a lot of money in the bank. But the surprising thing was, is I no longer had a job, and trying to qualify for a mortgage and buy investment properties was a challenge until I met you. You introduced me to some different ways that we could approach it, and we were able to obtain. I think last year we obtained 8, right?
I think
If I
so.
if I
Yeah.
remember right,
Yeah.
and we turned those all into rentals, and they're working out fantastic. I mean, that was kind of the dream for us is, okay, we'll sell the business, we'll go out, we'll buy a bunch of rental properties, and we will rent those out and then decide what else we want to do with the rest of our life adventure. And so in in doing that, the unique thing that I found my problem that presented itself was, okay, well, I have all this money and I want to be able to finance some of these properties and take advantage of maybe being able to write off interest and not just because I could easily go out and just buy them all straight out, but that wasn't really what I wanted to do. Um, so could you take just a moment and maybe talk about what you did loan wise to help us out, and then we can maybe talk about some other loans after that.
Sure. Yeah, I'd love to. I mean, it was so exciting to get a hold of you and to get when we got introduced to each other and to be able to kind of talk about your situation. Most people come to an investment situation with an income but no cash or very little cash. I mean, the biggest hurdles to getting into investment properties are usually capital. And so to find an investor who had the capital but happened to, because of a unique employment situation, not have any income was exciting. And it's one that I think most people would have run into and then just simply said, oh, I got to go get another job and wait 2 years or something to finance a property. But the reality is there's a lot of financing solutions out there for people who have capital. And, and in your case, one of those was a DSCR loan is what they call. They're called, stands for debt service coverage ratio. Um, these are these are loan programs that fit in the residential bucket, but function a lot like a commercial loan does, where we take a lot less emphasis on the borrower, and we put all that emphasis on the collateral. And so the way those loans essentially work is as long as the monthly rental income from the property, market rent, as determined by an appraiser, as long as that covers the mortgage payment, then the property is eligible for financing. And so when you come to a situation like that with capital and you're looking at buying investment properties, it's the perfect solution for you because you have enough capital to put down to get bring the mortgage payment in line with the market rent, and you can essentially finance as many of those as you have capital for. And so it was the perfect solution for you when you came in, and those loans are awesome. They don't look at you don't need income, you don't need a job,
It's good because I didn't have any and I
right?
didn't have a job.
Yes, you don't need a job, you don't need income. They essentially look at your assets and your credit score, and as long as you have those, you're eligible for financing on them. And as long as you have enough capital to cover the down payment requirements, which are typically like 20% at least. Um, and so yeah, that was the solution that we pulled up for you, and it worked perfectly, and you fit right in that bucket
Yeah.
pristinely. So
So talk about just for a second the 2 year waiting period because I could have waited 2 years to then turn around, tried to find a job, and waited 2 years to then turn around and buy all the investment properties. Is that still like a hard set rule with most of your loan packages, or how does that work?
so it depends on the type of employment. So if you look in the Fannie Mae Freddie Mac bucket, which is kind of your standard conventional loans, for a borrower who is self-employed, that includes you own your own business, you're a 1099 independent contractor, um, or who is 100% commission, you do have to have on those loan programs, you do have to have 2 year history of that. So you sell your business and you wanted to go finance a home on Fannie Mae or Freddie Mac, which is the kind of your standard conventional loans. If you went and got a job, a salaried employee at the school district or something, right? You wouldn't have had to wait 2 years in that case. You could have used that income as soon as you had a month's worth of pay stubs,
Oh, okay.
because we'd have used your self-employed employment history as, and then your new job to cover the 2-year employment history that Fannie Mae and Freddie Mac require, and then we would have just qualified you off of your salary job. However, the other way of looking at that would have been you sell your business and you turn around and you get a job doing, I mean, it's common here, summer sales, for example, where you're a
Mhm.
1099 contractor, independent contractor, and you're going door to door selling pest control. In that case, you're 1099 and essentially commission only. So you'd have had to have done that job for 2 years in order to be eligible for Fannie Mae or Freddie Mac financing.
Okay.
If we look outside of Fannie Mae or Freddie Mac, those are called non-QM loans or non-qualified mortgages, mortgages that don't qualify to be securitized by Fannie Mae or Freddie Mac. That loosens the guidelines up a bit. And you can usually do those if you're self-employed or 1099 or commission only. There's solutions for those where you've only been employed for a year, but it's difficult to find financing
For
under a
those.
year if you're self-employed and trying to use that income to qualify for a mortgage.
Okay. So if I was, say, older, getting close to retirement, and I had a lot of equity in my home, but I didn't have a lot of cash, in that kind of a situation, would I be able to approach a different type of a loan situation where I could pull money out of my home a little bit to then go and buy an investment property and just get the ball rolling? Because what I've noticed with most people that I've talked to about investment properties, and I realize my situation was unique, but just about everyone, oh, that's the dream. I wish I could just go out and buy a bunch of rental properties, and that's what we want to do. And I should have started, 10 years ago. And it's always kind of like the I should have. And we bought our first investment property, which was a home in 2010. And we've done quite a few different things, but the townhome situation with what we had with the loans that we obtained from you has been the best. But is there a mechanism where people can pull a certain amount of money out of their home if they have it close to paid off or they have a lot of equity, to where they can then turn around and leverage that to buy something like a townhome to begin renting?
Absolutely. In fact, I mean, I've been doing mortgages for almost 25 years. I've been working with investors for the majority of that time a lot. And that is the leveraging a primary residence is probably the most common way that most of my clients have gotten into their first investment property. Because again, capital is generally the largest hurdle for most people, is just coming up with that down payment. And so when you look at someone who's trying to plan for retirement or trying to replace their their career income with investment properties and they've got equity in their homes, yeah, utilizing that equity either via a second mortgage or a home equity line of credit is a wonderful way to kind of get in that investment property door. And you can use that equity, and if you had enough, you could use it and do those DSCR loans if you're right up against retirement or have retired, or if you are still working and you have income and you're trying to make that transition in advance of retirement. You could use that equity and just finance those on standard Fannie Mae or Freddie Mac loans, and use your income to qualify and rental income from the property and do it that way. But again, leveraging a primary residence is a perfectly acceptable and very common way of coming up with the capital to get into your first few investment properties. And it's a solution I wish more people knew, honestly.
Would take advantage of.
Yeah.
Is there a certain amount, let's say, just to throw out numbers' sake, the home is worth $1 million, and I'm buying an investment property that's worth $500,000. Is there a certain amount, and I have $500,000 in equity in my $1 million home? At what point do you say, okay, well, you either have you're getting into kind of a risky area because you're over leveraging yourself? I mean, have you seen that happen a lot, or is there a standard that is applied across the board for people trying to do that?
Yeah, I mean, what you run into in those situations is maximum CLTV or cumulative loan to value limits on the primary residence that you're leveraging. When you start looking at second mortgages and HELOCs, you're limited by two things: loan to value ratio and also loan amount. And so most people kind of run into a ceiling where the HELOC or second mortgage won't allow them to borrow more than 90% of the value of their home. And so if they owe 500,000 on this $1 million home in a first mortgage, the max they could go would be up to 900,000, and so the max they could get is a $400,000 HELOC or second mortgage. Um, and so that's kind of a limit that's kind of built into place,
Mm-hmm.
is up to 90. Whether or not someone needs that much or feels comfortable leveraging their home to that degree to go and buy another property
Mm-hmm.
is honestly more, in my opinion at least, it's more a matter of personal preference and risk tolerance and those things. I tend to look at it um, from an investment perspective. I look at it from like a net worth perspective. Borrowed money is borrowed money,
Yeah.
right? Whether you're borrowing $400,000 on an investment property or another $400,000 on your primary residence, your net worth remains the same. And it's just a matter of where can you borrow that money the cheapest. And so I would look at that situation, and I would also ask the question about what are your portfolio goals? Are you trying to buy one property, or are you trying to buy 5 or 6 or 7 or 8? Because
Mm-hmm.
the answer to that question really determines how heavily do you want to leverage your primary residence. If you just want to buy one property, you probably don't need to go pull out $400,000 in your scenario unless you just wanted to buy it in cash almost.
Mm-hmm.
But if you have a goal of, hey, I'm trying to replace my $12,000 a month career income with rental properties, and you're wanting to do that in the next 5 or 10 years so you can retire, then I would say to leverage get as much equity as you can, and then spread that over as many properties as you can,
Mm-hmm.
investment properties, to get those properties, in your portfolio. And then once you own them and you get a couple of year history of owning them, then we can start look at restructuring the financing to put you in the very best possible position for cash flow or debt elimination, ideally about the time that you're looking to finally retire and need to live off of those properties. The mistake I see some people make is they're like, oh, I want to own 5 properties. And so they'll go and they'll pull out all the equity in their house and they'll go buy one property, thinking then that they're going to save up the equity to buy the second, third, fourth, and fifth. And that's generally the slowest possible way to do it.
Mm-hmm.
I would say, hey, if you're going to leverage your property, don't just put it all on one and get $100,000 mortgage so you can cash flow $1,500 a month. Let's take that $400,000 and put it down on and spread it across 3, and let's get you into the market so you have 3 properties appreciating. You get the tax benefits of writing off and depreciating 3 properties.
Mm-hmm.
You get a little bit of cash flow on all of them, and then once you own them and as they appreciate in equity in 2 years or 3 years or 4 years, let's look at restructuring that financing to maximize your cash flow at that point. And that perspective takes a little bit of a strategic outlook
Mm-hmm.
versus just looking at each property, short term. How do I get into this property and maximize the cash flow on it? Is a little different than I like to do it for
Yeah.
someone who's trying to build a portfolio. I would prefer to look at their goals and what's the fastest way to get there, and how do we spread their available capital, cash on hand or equity in a primary residence or both, to get to that goal as quickly as possible.
Okay. That's good to know. It's years ago when we purchased our home. I think we paid about 700,000 for it, and by the time we sold it, it was well over 2 million. And granted, it was a 15-year time span, but the appreciation, um, could we have halfway through, let's say it appreciated $600,000 in the first 3 years, because there were people. I mean, we found this little gem pocket of a place to live, and all of a sudden everyone discovered it, and they started moving in. You know how it works.
Yeah.
And so the values went up, considerably. Uh, would we have been able to, say, 5, 10 years ago, take advantage of that appreciation on paper to then leverage and go out and purchase a rental property? Could you talk a little bit about that?
Yeah, I mean, that right there, that principle is one of the most appealing parts of investing in real estate is that it goes up in value. Just because you own it and the property exists, it just goes up in value, and it has historically gone up in value, with the exception of the 2008 recession,
Hmm.
um, in which values recovered and then continued going up beyond that. And so that's one reason I would say it's better if you want to build a portfolio. It's better to spread your capital and get into as many properties as quickly as you can, because now you have, instead of buying one that's appreciating in the market, now you have your primary residence and two or three or four that are appreciating in the market. Because as they continue to go up in value, what you're doing is you're leveraging those properties then to help you get into additional properties, and you can build your portfolio so much faster doing it that way
Hmm.
than you can by buying one and then trying to save up money for your next 20% down payment with the cash flow, um, or waiting until that property goes up enough to buy another. And so, yes, as the properties go up in value, you can continue to leverage them. You can continue to take advantage of that equity and roll it into future properties if you'd like. I look at investing, I kind of look at it as three phases of, of investing. I have like the property acquisition phase, where, and it's different for everybody. Everybody has different goals, and some people want to have 15 or 20 doors, and some people just want to have one or two.
Hmm.
And in the property acquisition phase, what I'm looking at is I'm looking at, again, spreading their capital over as many properties as possible, trying to help them get to whatever their portfolio goal is as quickly as they can. And if that's five, it's five. If it's one, that's fine. There's no, I mean, whatever works for them. But we're just trying to get them to their portfolio goal as quickly as we possibly can. And we structure the financing differently. We're doing lower down payments. We're not as worried about cash flow. We're just trying to spread the properties, and then we look at leveraging. Once we get to that goal that someone might have for them, whatever that goal is,
Hmm.
then I go into the debt elimination phase. And I look at, okay, now you've got your 10 doors. What do we need to do to pay off these mortgages as quickly as we can, so that you then have mortgage free cash flow for when you're ready to retire?
Which is what everybody wants.
Right?
Yeah.
That's the goal. And you, to your point, you get there. Everybody wishes they would have started 10 years or 15 years sooner. But once we get into that phase of ownership, we look at just paying those mortgages off. Sometimes that's by refinances. Sometimes it's by consolidating mortgages on multiple properties into one. Sometimes it's refinancing to shorter loan terms. Sometimes it's by selling and taking these older properties that you have equity in and selling those and doing a 1031 exchange into a newer property.
Hmm.
Um, but we just look at it as a whole, as a strategy, and just what do we need to do to get these properties paid off. I work with real estate agents to kind of evaluate where they're at in the market, can evaluate where those properties are location wise. Is it still a good location to own a rental property? What condition are they in? What expenses do we have coming up? Does it make sense to sell that one and roll it into another one? And so it's just this team approach of looking at how do we get you your 5 or 10 or however many you want properties mortgage free by the time you're 55 or 65 or 70 and want to retire. Um, and again, it's a holistic approach. It's not one property at a time. It's looking at your
Yeah.
whole portfolio, including sometimes the primary residence. And then once we get that done, then you're in the cash flow phase, and then you just maintain those and you look at those, and once they're paid off, you still have to include the realtor in those conversations. I would recommend that someone check in with a real estate agent every year or so, just to review their portfolio, to make sure that they haven't, the city hasn't approved a landfill
Hmm.
two doors over, two blocks over, that's going to hurt your value,
Then
or
you can't get a loan to.
right, or make sure that there's not a railroad track being that's going in, a half mile away, that's going to affect your equity position. And so you kind of do those, and so it's not pay them off and then I'm good until I pass away. It's I paid them off. Now I've got all this equity. Now I need to make sure that I'm protecting it. And sometimes that's strategically selling and rolling over to a new property and those kind of things. And so those are the three phases that I would look at. as far as someone who's trying to build an investment portfolio and looking at trying to retire on real estate, at least partially.
Okay. I know early on that one of our first rentals was a condominium, and you talked about checking with a real estate agent on a yearly basis to make sure that there isn't something coming into the area that would affect the values, or maybe even affect the ability to get a loan. And I was a little bit surprised after I purchased my condominium to learn about some of the rules that apply to the resale of condominiums, and when
Mm.
it comes to how many individuals are renting versus how many individuals own. And I wasn't aware of that at all until I decided to become a real estate agent myself. Are there any other things that would affect your ability to be able to either buy or sell by a development coming in and a certain type of development or something going in the area that would affect? And sorry, we'd love to give you a loan, but we can't.
Usually, if the cities are approving residential, there's a way to get a loan for it. But those external influences are as they're affecting the value or resale of the property, right? I
Mm.
use my extreme example of you buy an investment property and then the city approves a landfill or something, right?
Mm-hmm.
It's a little extreme, a little comical,
Yeah.
but nevertheless, it illustrates the point. If you own a piece of real estate, and then the city does something or changes zoning that is going to negatively affect that the investment that you have, right? You have to reevaluate and then possibly look at selling it
Yeah.
and moving your equity someplace else is a strategic move. And you mentioned condos,
Yeah.
and I have this conversation a lot with investors. It's like, oh, I want to buy a condo. I'm like, okay, no, that's fine, you can do that. Just be aware that if when you go to get a loan on a condo, they're going to have higher rates. The question is always like, why do they have higher rates? And all I can say is that condos have proven to be a more risky investment over time than a single family home or a townhome. And so Fannie Mae, Freddie Mac, other lenders, investors, they offset that risk with a little bit higher interest rate. And then if you're trying to go the Fannie Mae, Freddie Mac conventional financing route, the condo has to be what's called warrantable. And there's a whole bunch of qualifiers that go into whether a condo development is warrantable or not. One of those you mentioned, which is the percentage that are rented versus owner occupied. If there are more units rented than owner occupied, the property is not warrantable. They look at the HOA. Is there any litigation that the HOA is involved in outside of trying to recoup back HOA dues? But is there any litigation? They look at the budget. Do they have enough? Is the budget of the HOA sound? How many floors is it? Is it above 4? Is it 4 or more or less? They look at all of these different factors that determine whether or not it's even eligible for conventional financing. So if you're looking at a condo, you might come in and I've got my job and I've got great income, my debt ratio is in great shape. I want to
Mm-hmm.
go buy a condo. So you go under contract only to find out that, oh, this condo is not warrantable. So if you want to finance it, you have to go finance it outside of Fannie Mae or Freddie Mac, or you have to pay cash for it. And that's a pain on the purchase. It can be a real pain when you try and sell, because you buy it as an investment property and you're not worried about it. You're a cash buyer. You go buy it in cash, then you go to sell, and you're trying to sell it to this first-time home buyer, and then all of a sudden you own a condo that's not warrantable, and so everybody's having a really difficult time financing it,
Mm.
and it's hard, and so you're waiting for another cash buyer to come along versus your typical first-time home buyers wanting to get into a small condo for their first place and those things. And so that's one factor on the condos you really have to look at. I always also tell investors this, though, on condos, is you can't tell if it's a condo by looking at it. You have to look at the county records, and the legal description of the property is the only way to really tell. And I can't tell you over 25 years how often I've had a contract come over that's listed on the MLS as a townhome.
Hmm.
Price it out as a townhome, we underwrite it as a townhome, and then we get the appraisal and title report. And they come in and we're like, oh, this is a condo. What do you mean it's a condo? It looks like it's a side-by-side
Yeah.
unit, just like the
Yep.
townhome I'm moving out of. I know, but the developer, when they wrote up the legal description, they called it a condo development, and so it falls under those guidelines. And so you just have to be careful
Yeah.
on those. And it's not that condos are a bad investment. It's just something that you have to look at with a little more caution. And most HOAs now are wise enough that they understand that they won't allow too many investors in there, and they
To
kind
come
of
in.
understand those guidelines. But nevertheless, it's a risk that I've seen.
Yeah, that's funny. We ran into that exact thing. I walked through it and I thought, oh, this will be a great townhome, and then I found out this is a condo.
Yes.
So it is easier than it's just like you said. You can walk through it, but you just don't know.
You have to look at the legal
So
description, and I mean, when I say rates are higher, I mean, 1/4%, eighth of a
yeah,
percent, just depends on what your down payment and credit score are. But yeah, that's a big thing on those condos. Whereas
on
a
condos.
townhome is going to they're going to treat those the same way they would a single family residence.
Okay. Well, I'd like to wrap up on one other question.
Sure.
And I don't know why I thought about this, but the other day I was up around an area here in Utah, and as everyone knows, we're going through. We didn't get a lot of snowfall, so we're going through a little bit of a drought. And I remember years ago, I had a family member who lived up South County portion of Utah, and there was a fire, and it got very, very close to some of the developments that were going on. And maybe this is more of an insurance question and not a lender question, but have you ever run into the obstacle of not being able to give someone a loan because where they were trying? I mean, you say the city goes in and they approve it, and it's generally okay. But then 10 years later, there's a fire that comes right to the doorstep. Do things like that, natural disasters and things, affect whether or not you can give out a loan?
Yeah, it can. I mean, insurance is required,
Yeah.
right? And it's not that we wouldn't give the loan. It's that if you can't get insurance on that property, we can't give you a loan for it.
Mhm.
And so they're actually dealing with this in California a lot for fires, and in Florida for hurricanes,
Mhm.
where a lot of insurance companies are pulling out of those states because the losses have been so tremendous in California because of those fires. And so trying to buy a house and you can't get insurance on it,
Yeah.
you can't get a mortgage on it, right? But if you could get insurance, you could get a
Yeah.
loan. But what you're looking at that point is, what is that premium going to be?
Yeah.
And I mean, it's asset protection for you as much as it is, for the insurance company. But if you're buying in a neighborhood that is possibly susceptible to forest fires,
Yeah.
I mean, you're going to want to have coverage for your property.
Yeah.
How much is that going to cost? And are you able to afford that? More common would be flood insurance, right? The FEMA has their flood plains and their 50, 100, 500 year flood risk areas. And if a corner of your property happens to be in a flood zone, and when the lender goes to do a flood certification, it's going to come back in a flood zone. And so you have to go and get flood insurance for your property. And flood insurance is typically, I mean, I've seen it be $3,000 a year, where the standard homeowners insurance premium is $1,000 or $1,200.
Yeah, that's a
And
lot.
so it just increases the cost, and so you just have to be aware of those going in. And so it's not that a lender wouldn't give you a loan if you
Mhm.
needed really expensive insurance or if you couldn't insure it. It's just the insurance won't give you any coverage. We can't give you a mortgage.
Okay.
But again, those things, as an investor especially, when I talk about meeting with realtors regularly to reevaluate your portfolio, like those are the kind of things that you need to consider, even if you own them debt free, even if they've been great rental properties. Those are the things you may want to consider about, oh, maybe we do need to sell this property and do a 1031 exchange and do a different one in a different
Yeah.
location.
And that's a great thing. 1031 exchange, a whole different conversation for
Yes,
another
it's for
time,
another
but
day. Yeah.
they are great. Well, thank you so much for coming out and joining us and
Glad you
talking a little
invited
about
me.
loans. So
You
appreciate it.
bet. It was fun.
All right.
Thanks, Brent.